Remind me what the background of that Shackleton story was.
Well, so that's where our stories were sort of similar in terms of how we thought about the year. So I was talking about Sir Ernest Shackleton in 1914 taking this expedition. He had a crew of 27 down to Antarctica to cross Antarctica by foot. And I started, the more I learned about the story, the more enamored I became with it, because you think about 1914, a couple of years after the Titanic hits an iceberg, this guy goes out on this expedition in a wooden ship to cross Antarctica. And within a short period of time, ship's frozen in the ice, and they're left trying to figure out how they're going to get out from underneath all of this. And I love the story because the whole time, at least early days, they thought the ice will melt. We're going to get out of this. This is going to be just fine. And so they're going on with their work every day, only to find out that the ice eventually overtakes the ship and sinks it. And they actually found that ship last year, 10,000 feet below the Weddell Sea.
So they never actually got the ship off of shore. It just stayed there.
It stayed frozen in the ice.
So how did they actually did they get rescued then?
So it was an incredible story of how they actually survived this, because I think the whole expedition was something like almost 2 years front to back.
There was no sending communications probably at that point.
No, think about 1914. Just think about what gear they had, yeah. Right? They didn't have the synthetic gear that we have today. They didn't have all the technology we have today. I mean, they probably had wool. Right, wool clothes, they had tents. They got off a lot of the things off the ship before it sunk. So because they were on the ship, they heard the cracking, and they were able to get a lot of this stuff off to try to help to get them to survive. But I don't recall the specifics of how they made it. But it was a long journey to safety, and it was just Shackleton and a couple of the crew. And they left a lot of the guys behind where they had been to row essentially and sail with the dinghy that they had to get to safety. But it was an unbelievable story of rescue and heroism, and they all survived, which I think was really the punchline of that story in my mind.
That's the big takeaway.
Right? I mean, that's the big takeaway. They all survived.
All right. Well, we're going to get started. My name is Ryan Isakainen. Welcome to the First Trust ROI podcast. Joining me for this episode is Bill Housey. Bill has been with First Trust for, I believe, about 10 years. He is a managing director of fixed income and senior portfolio manager. He's been in our industry for about 27 years. So, Bill, thanks for joining the podcast today.
Pleasure to be with you, and we're going on our year 14.
Year 14.
Yeah. It's unbelievable how time flies.
Bill, you spend a lot of time traveling around and talking to financial professionals when you're not doing your day job, which is managing mutual funds and ETFs and managed accounts. And we get a lot of questions, which is great because it helps you understand what people are thinking about. And sometimes they're questions that you agree with, sort of the premise behind the question. Sometimes they're questions you maybe disagree with. As you've traveled around this year, what is the number one question that you have been getting from financial professionals about what's happening in the economy and the markets?
I think the most prominent question on people's minds today, at least from the conversations that I've had, the television stories that I watch, the news that I read, is really whether we're heading into a recession or not. It's hard landing or soft landing. That's really, I think, the ultimate crux of where most people are focused. And, hey, the S&P's up 1,000 points from the low. It's easy to see why the narrative of soft landing has been as strong as it is. But I think that's probably what's on most people's minds.
Okay, so take a step back. We hear a lot about hard landing versus soft landing. What do we mean by that, I guess? Are both of those scenarios consistent with a recession, and maybe it's just the depth or severity of the recession? What do we mean by hard landing, soft landing?
Or no landing.
Or no landing.
Right? That's the other one. So I do think that hard landing would be recession and a harder recession. Maybe soft landing is mild recession, and no landing is no recession at all. And it seems like, at least from what I can gather today, most investors are in the no landing camp. I mean, after all, if the S&P is 4,500 to 4,600, it certainly seems to me to think that to sort of think that the market is no landing, right? Why would you be there if you thought that there was going to be even a mild recession? So, but that's how I would distinguish it. And I always like to joke about this, but I think handicapping the probability of recession is incredibly difficult. Attempting to assess the potential severity of a recession is nearly impossible, right? And the timing, of course, is always unknown. So, there's three different dimensions when you start talking about the type of landing.
So is there a good way to know when we have landed, I guess, in any of these scenarios? Apart from, 6-9 months later, the National Bureau of Economic Research saying, oh yeah, we were in a recession then. What are some of the things that people should pay attention to?
Well, I think as you look at the market over time, people are going to assess what's happening to employment over time, what's happening to growth in the economy over time. And a lot of these things are only known in arrears, right? And we can't look at the stock market to be the be-all, end-all indicator because, as you know, I mean, stocks go down. That doesn't mean the economy's in a recession. They can certainly be decoupled. Stocks go up. Doesn't mean you're not heading into a recession. So there's a lot of different decoupling that can take place in the market. But I think ultimately the reason that it becomes so difficult is because a lot of the things that we look at to discern whether we're in a recession, they're lagging, right? They're very lagging. In fact, the employment rate in particular is one of the most lagging indicators that anyone can look at.
I want to talk a little bit more about the employment rate and the really low unemployment, whether a recession is even, some people say it's not possible with a rate of employment or unemployment that's this low. But before we do that, I want to ask you about the yield curve in particular. Your team put out a piece recently that talked about the yield curve and how it has been a reliable indicator that has sort of predicted recessions, so a leading indicator in the past. And I think it's one of these indicators that is a bit misunderstood, and some people have begun to question whether it's going to work this time because we're pretty deeply inverted. So what's your take on that?
Yeah, it seems as in nearly every cycle, there's this debate that occurs about the yield curve, about whether it's viable this time, whether it's different this time, whether it'll be a good predictor this time. And, I still believe that it is a good indicator for us for the business cycle. The challenge is, and this goes back to Milton Friedman's long and variable policy lags, right? The yield curve is such a leading indicator that it's so far out that people, because they look for that instant gratification, they say, when you start to see the yield curve invert, the first thing they say is, oh, the yield curve's inverted. This must mean something terrible is happening. And then they look around, and a few months later, nothing's happened, and they say, oh, it's different this time. The yield curve isn't valuable. But what we did is we wanted to point out that, yes, there have been some inversions that didn't result in a recession, but we said, let's look more closely at this to try to assess, for people's benefit, the length of time that it typically takes from inversion to recession. And when you look at that data, for example, I like to look at the 2-year Treasury against the 10-year Treasury, that curve. I think that's a really good leading curve. Tends to invert first before 3-month bills against 10s invert. So that's why I like to look at 2s and 10s. So when I look at 2s and 10s and I say, wait a minute, we're inverted, I try to start thinking about how inverted are we? How long have we been inverted? Now, the 210 curve inverted about a year ago. So it was around last July of 2022, we had the inversion in 2s, 10s. And it's basically been inverted ever since. It's over 100 basis points inverted today. And that's really one of the steepest inversions we've seen since the 80s. So we've had other inversions since that have preceded recessions. They just haven't been as steeply inverted. And that makes sense because the Fed controls that front part of the yield curve. So when they're raising 500 basis points in a very short period of time, that front part of the yield curve really reacts aggressively to that. And 2-year Treasuries tend to land right around where the Fed is going. So you get the sense of why that front end is moving up so aggressively. While the back end of the curve, well, it's pricing in expectations as well, but over a much longer horizon. So what are our expectations for inflation? What are our expectations for growth? What are our expectations for Fed policy over time? But in fact, as we look at that yield curve, what we tend to see is that it is a very long time between inversion and recession. In fact, we ran some analysis on that, as you mentioned, and so we're about a year in today from the inversion on the 2s, 10s, and the average time is around 478 days from inversion to recession. The median time is 502 days, so we're talking about being about 12 months into this inversion today, an average and median times of 16 to 17 months for which you have this lead time for the ultimate recession to hit. So by every measure, we shouldn't be in a recession today. But I also think that until we're through a typical length of time, we're not out of the proverbial woods yet.
So you don't think, to summarize, that the signal has failed? It's actually not supposed to have started. A recession doesn't typically start this soon after the yield curve has inverted. Have I got that right?
Yeah, that's right. I mean, we looked at the last 5 cycles, and I excluded the COVID cycle from the analysis because we did have some inversion in the curve, but then I would be the first to tell you that I don't think yield curve inversions predict government shutdowns of the economy and sort of government-induced recessions. So that one seems like an outlier scenario, and so in my analysis, I thought it was appropriate to kick that one out. But looking at a traditional business cycle, right, those are the cycles we looked at, and when we analyze those cycles, it takes a long time for these yield curves to sort of come to pass to a point where you say, wait a minute, it was right this time. And so when I look at the severity of the recession, the depth of that inversion, 100 basis points on 2 10s, over 150 basis points on 3-month bills against 10s, those seem to me to be incredibly important warning signs for us today. And that's why I certainly don't want to take our eye off the ball with respect to that. And that's why we think it's still a very valuable leading indicator. So
you mentioned that you excluded the COVID recession because of, I think, reasons that make sense to most of our listeners. But then the question is, well, could it be different this time? Because we're in this period post-COVID where all sorts of things are different. Is there a chance that maybe it's different and that the inversion of the yield curve is not going to lead to a recession? And actually phrased differently, why do inversions of the yield curve often lead to recessions? Is it a causation, or is it just something that tends to happen afterwards?
Yeah, it's a really good question. So of course, there's not everything we do, there's no 100% chance of any outcome. So there's always a probability of something not having the predictive power that you thought it would have. In the case of the yield curve, I don't think we can rule it out yet. And do I think that there have been things that have led to this cycle being unique? Of course. Well, number one, it would ultimately be a very short business cycle. Business cycles are typically longer than the one that we think this will be. But a lot of that is because the cycle is different, right? You had just trillions of dollars injected into the economy, which led to demand outstripping supply, right? So the Fed and others have called that supply chain disruption, but it was trillions of dollars being injected into people's checking accounts, people going out and spending, demand outstripping supply. So certainly there are supply chain disruptions when everybody's running out and spending all that money. Those supply chains need to rebuild, but the Fed has reacted very aggressively, and now we're seeing money supply contraction as opposed to the big money supply growth boom that we saw. But typically these are the things that money supply contraction that and just the passage of time and inflation, which erodes some of that money supply growth over time, that's where you come up with this long and variable policy lag. So I think my intuition around this is something like this. Think about the way a bank makes money, a typical bank, right? So borrowing from depositors, money goes into a deposit account. What do banks do? They take that money, they make loans to customers, right? And if the yield curve is upward sloping, the economics of those loans relative to the borrowing costs can be really fruitful. They make a lot of sense for these banks. But as you see inversions in yield curves and you think about the economics of making those loans, right, for a bank where they say, wait a minute, this curve is inverted, right? I'm borrowing here, I'm lending here, but it's priced off of a lower number out the curve. It starts to cause banks to say, oh, wait a minute, we're going to start to tighten our lending standards. And so the financial institutions are the backbone of the economy. So as you start to tighten those financial conditions, well, does that have an immediate impact on the economy? Well, not in 15 seconds, right? Does it over time start to impact the economy? In my opinion, it does. And that's where it takes, could be 16 months, could be 18 months, but this Fed has moved very aggressively, 500 basis points in a very short time. I don't think you feel that right away, but I do think we will start to feel that over the next several months.
I wanted to ask you about the Fed in particular and what your outlook is from here. As you mentioned, they've been very aggressive in raising rates, 500 basis points.
Yep.
Are we done? Do you expect another rate increase? How many more rate increases do you see between now and the end of the year?
Sure.
And why has the market been so wrong in pricing in expectations?
Sure. Well, I think there's a lot in there to unpack in that question. But as you look at the Fed, they have a dual mandate, right? It's inflation and employment. And one of the things that we've tried to key in on is the fact that this Fed has obviously, they woke up to transitory being wrong. And they were very concerned about how wrong they were. And so they had to move much more quickly. And when they look at the analysis today, right, they are very aware of long and variable policy lags, so they don't want to do incredible damage to the economy, although I believe this Fed thinks that whatever damage they do, they can solve by going the other direction. But I ultimately think that this Fed will continue to leak additional hikes into the market until, as Powell has put it, the job is done. So we have to start to really make sure that we understand what that means. What does it mean to have the job done? So what are they concerned about? Well, obviously they've been concerned about inflation. We've had disinflation. Inflation has been trending lower. We're not back to 2% though, right? We're certainly not there with core. And so this Fed is still concerned about inflation, but they're also very concerned about the tight labor market. And I think that this Fed will continue to leak hikes into the market until they start to see that unemployment rate begin to climb. And as they see that unemployment rate start to climb, that will give them comfort that the job is done. The challenge with that is that you typically see that unemployment rate climbing when you're either in a recession, or knee deep in it, or waist deep in it, or right in front of the recession. So you can look back at every previous business cycle going back to 1960, and you would see that unemployment rate doesn't begin to climb until you're either right in front of and staring into the recession, or you're in it. And so that's why I think that the probability of a recession, whether you're looking at the yield curve or whether you're looking at the Fed's own track record, is as high as it is. I don't believe that the Fed has, despite some of the differences in this business cycle, that the Fed has any sort of clairvoyance about what the right neutral rate is that could lead to the no landing scenario. And their track record proves that in just about every prior cycle, they raise rates to the point where they ultimately break something in the economy, and that's where you get that recession.
So the last I checked, the market was pricing in cuts still next year. Mm-hmm. Next year is an election year. Do you think that will have any impact on what the Fed does leading up to an election? Will their actions be impacted by that, do you think, at least on the margins?
It's hard to know. Should it be? The answer is no, right? The job is the job. It's a dual mandate. It isn't a triple mandate, right? It's employment and inflation. It's not employment, inflation, and politics, right? But somehow I think it does come into play. Ultimately, though, as we look out that far, when we start to talk about that point in the cycle, I think we'll know full well about whether or not we have a recession by then. That aligns with our yield curve analysis, that aligns with some of our own predictions about where we see the overall economy heading, and certainly where our own chief economists and deputy chief economists, Westbury and Stein, have been with respect to timing of an ultimate recession. So I think those things sort of coalesce around that recession case before an election anyhow. So it's possible and probably even likely that they are backing off in terms of interest rates by that point, because I think we'll know where we're at with this economy by then.
So as a portfolio manager, you are in your team, you're analyzing companies, you're evaluating their creditworthiness. To what degree does a sort of a top-down macro discussion about the economy impact what you're doing? Does it, as a portfolio manager, does it really matter to you whether we're in a recession, heading into a recession, coming out of a recession? Does it impact what you're doing on a day-to-day basis?
Oh, incredibly so, right? We have to make sure that from a positioning perspective that we're thinking through any possible scenarios in terms of where our base case is, where do we think the economy is heading, and just think about it from a sector bet perspective. When do I want to lean into cyclical bets? Do I want to lean into cyclicals before a recession? No, probably not, because I think they're going to cycle down, but I certainly want to leg into those into the downturn, as I think we're going to make a turn. When will I see that turn? Most likely it'll be when we see that, what I call with that bull steepener. What drives that in the yield curve is when the Fed is slashing rates, or at least expectations for the Fed to be pricing in those rate cuts starts to work their way through interest rates, and you go from this massively inversion in the yield curve to something much steeper, right? We're going to be looking for those signs to give us an indication of where we want to be. So absolutely, we have to be thinking about where we want to go with respect to the economy so that we can position appropriately. We have believed that because we think we're going into a recession eventually here, because we think the probability of the Fed engineering this immaculate no landing scenario where I have inflation come back to 2% confidently with no change to the unemployment rate, and the economy continues to expand. So that's certainly what some people are betting today. That's just not our bet. So we would much rather be up in quality, more defensive. We want to make sure that we are positioning for that view. Ultimately, though, it becomes tricky because yields are a lot more attractive, because when you're pricing off of a higher Treasury curve, and let's just unpack that a little bit. How do bonds price, right? I start with a risk-free rate and I add on a spread for the risk that I'm taking. So in low quality, junk rated credit, that spread should be a lot wider, and of course in high quality, it's a lot narrower. And what we're seeing is those spreads are relatively tight, but the all-in yields remain pretty compelling, especially when you're pricing off of a yield curve that has baked in 500 basis points of hikes. And of course, it's moving around a lot because it's based on where the market sees the Fed heading in the future as well. So are we pricing in further hikes? At the end of the second quarter, it looked like we were pricing in at least 1 to 2 additional hikes, and they were going to hold rates higher out to the middle of next year. That's sort of what was being priced in. I called that more fair value. So as we're pricing off of that, the all-in yields start to look really attractive. If you're getting 8.5% to 9% in high yield, for example, well, that can certainly offset quite a bit of volatility. I've got to lose 8.5% to 9% before I lose a penny when I'm riding a coupon that high, for example. So these yield levels can help to sort of be a really good shock absorber, despite the fact that spreads are running a little tighter, and that's probably why we're seeing spreads tighter. But I also think that into an equity tape where volatility does pick up again, potentially into that weakening economy scenario as we move forward over the next 6 months, that's when we'll see those spreads widen out again. But you also see rates moving down as well. So you'll have a dual variable there.
Bill, it seems like as I think about the last 10 years, much of what we talked about was positioning fixed income portfolios for an ultra low rate environment, a rising rate environment. Now we're at a point where rates have moved up. And as we've been discussing, the Fed is much closer to the end of their rate hiking cycle. And my question is, how should investors be thinking about positioning client portfolios, or investment professionals positioning client portfolios for this kind of environment? Because this is different than we've seen for quite a while. So what are your thoughts there?
You're absolutely right. And I think ultimately it's important to remember bonds are just mathematical instruments, right? It's a lot different when we start talking about the stock market. And I like to joke about the fact that there's a lot of hope embedded in stock prices, at least in the short term. Over the long term, Dave McGarrell, our CIO, and we talk a lot about this. Of course, there are absolutely drivers of valuation and fundamentals that drive stock prices over time. But in the near term, there's a lot of hope in stock prices. When I look at a bond, it's a mathematical instrument. And so one of the things that I think investors have to be aware of is the fact that after 500 basis points of rate hikes, the math in bonds is a lot different than it was when the Fed was embarking on this rate hiking expedition back in March of last year. So when you started out with zero interest rate policy, you had no shock absorption against higher rates. So while I still think that the Fed is going to leak additional hikes into the market, and the Fed has no idea when they're going to be done. This is why investors have been so wrong with respect to Fed predictions. How are we supposed to predict where the Fed's going to end when the Fed has no idea when they're going to end? They're reacting to data that's coming in. And so when we're looking forward, sure, there'll be additional rate hikes that are coming into the market. At least that's my view. They will leak those hikes into the market over time as they react to this data until they're ultimately sure that the job is done. But when we look at bond valuations and bond math, income relative to duration or rate risk, I think that equation is a lot more balanced today. And in fact, we have to go back to 2009 to find a time where if I were looking at yield relative to rate risk or duration in the ag index, the Bloomberg Ag Index, which is all my high quality, safe fixed income, I'd have to go back to 2009 to find a ratio that's comparable to today. So that valuation looks a lot better to me. I think that investors would be wise to start thinking about reinvestment risk as opposed to rate risk, at least at this point. After 500 basis points of hikes, it's very simple for me. I don't think there's 500 basis points left in the magazine, right? I think they've spent 500 rounds. There's probably not 500 left. And so that means that while they may leak additional hikes in and probably hold those rates higher for longer, until we see sure signs that something is turning to give them the confidence that they've achieved the outcome they're looking for, which in my opinion, more likely than not, is going to be a recession. I think that reinvestment risk is going to be probably the most important thing that investors can be thinking about today. Because 12 months from now, when those really high yielding CDs and T-bills and those short-term securities that investors have put their money into start to roll over, the reinvestment environment could be very different than what we're in today. So the ability to lock that in for longer and work that duration out, I think could be a real ballast against risk assets for quite some time, especially if you work that duration out further at a time where valuations make more sense to do so.
And reinvestment risk isn't really a concept that we've talked much about over the last decade because you haven't had a scenario where you want to lock in high yields.
That's right.
And you've got the potential for them heading lower. And as you pointed out, you've got to reinvest that as bonds become due. And if you're ultra short and 3-month T-bills, you're going to have to reinvest in a lower rate environment potentially as rates move lower.
Exactly.
Well, Bill, thank you for joining the podcast. It's always great to get your insights. Great having the conversation with you. Thanks to all of you for joining us as well on the First Trust ROI podcast. I'm Ryan Eastkainen. Thanks.